Introduction: Technical Analysis of the Financial Markets. Welcome to Technical Analysis of the Financial Markets by John J. Morphy. In this introduction, the author explains what technical analysis really means and why it's one of the most powerful tools for traders and investors. Technical analysis is the study of market action, mainly through charts, to predict future price movements. In simple terms, it focuses on what the market is doing rather than why it's doing it. Morphy describes three key principles that form the foundation of technical analysis. First, market action discounts everything. This means that all known information, whether economic, political, or emotional, is already reflected in the price. So, by studying the price itself, we can understand the complete behavior of the market. Second, prices move in trends. Markets don't move randomly. They move in trends upward, downward, or sideways. Once a trend begins, it's more likely to continue than to suddenly reverse. Third, history tends to repeat itself. Why? Because human nature doesn't change. Emotions like fear, greed, and hope drive market behavior, and these emotions create patterns that repeat again and again. Morphy also tells us that technical analysis can be applied to any market, whether it's stocks, commodities, currencies, or bonds, because all markets are driven by the same human psychology. He reminds us that charts are the trader's most valuable tool because they clearly show how supply and demand interact. In conclusion, Morphy says that technical analysis is both a science and an art. It provides a structured, logical way to study price behavior, but it also requires intuition, experience, and judgment to master. And that's what this book is all about, helping us understand how markets move, how trends form, and how we can read the story that prices tell. Lesson 1: The Basic Concepts of Technical Analysis. From Technical Analysis of the Financial Markets by John J. Morphy. Welcome to Lesson 1: The Basic Concepts of Technical Analysis. In this chapter, John Morphy helps us understand the foundation of how technical analysis works and why it is such an important tool in the world of trading and investing. Technical analysis is the art and science of studying price movements through charts in order to forecast future trends. It is based on the belief that everything that affects a market's price, whether it's earnings, news, politics, or emotion, is already reflected in the price itself. That means, instead of analyzing a company's financial statements or economic data, a technical analyst focuses only on price, volume, and time. Morphy explains that technical analysis stands on three main pillars. Pillar 1: Market action discounts everything. Every possible factor that can influence price, company performance, government policy, global events, and even trader psychology is already built into the market price. The chart reflects all of it. So, a technical analyst simply studies how price behaves, not why it behaves that way. Pillar 2: Prices move in trends. Prices don't move randomly, they follow trends. A trend means the general direction in which the market is moving up, down, or sideways. Once a trend starts, it usually continues in the same direction until signs of reversal appear. Traders who can identify and follow these trends early can profit the most. Pillar 3: History repeats itself. Human emotions like fear, greed, and hope never change. That's why market patterns tend to repeat over time. By studying past price charts, analysts can recognize familiar patterns and use them to predict what might happen next. This is where chart patterns, like head and shoulders, double tops, and triangles, become powerful tools. Morphy emphasizes that technical analysis is not magic. It's a logical system that helps traders understand the ongoing battle between supply and demand. When demand is greater than supply, prices rise. When supply is greater than demand, prices fall. Charts simply help us see this battle more clearly. He also reminds us that technical analysis applies to all financial markets, stocks, bonds, commodities, and even currencies, because human psychology drives all of them. Lesson 2: The Doe Theory. From Technical Analysis of the Financial Markets by John J. Morphy. Welcome to Lesson 2: The Doe Theory. This lesson introduces one of the oldest and most respected foundations of technical analysis, a theory that shaped the way we understand trends in the financial markets. Blue Book. What is the Doe Theory? The Doe Theory was developed from the writings of Charles H. Doe, the founder of the Wall Street Journal and co-founder of Dow Jones and Company. Even though it was created over 100 years ago, its ideas remain timeless and relevant in today's modern markets. John Morphy explains that the Doe Theory is not a set of trading rules, it's a philosophy about how markets behave and how trends are formed. 1. The market has three movements. According to Doe, the market always moves in three directions at the same time, like waves within waves. The primary trend. This is the main direction of the market and usually lasts for 1 year or more. It's the big picture, the major bull market or bear market movement. The secondary trend. These are temporary corrections that move against the main trend. They last from a few weeks to a few months. Think of them as the market taking a breather before continuing in the main direction. The minor trend. These are short-term daily or weekly fluctuations that traders often see as noise. They last for a few days or even hours. Doe compared these trends to tides, waves, and ripples in the ocean. 2. The market has three phases. Each major trend, whether bullish or bearish, passes through three distinct phases. For a bull market, the phases are: accumulation phase. Smart investors start buying when most others are pessimistic. Prices are low and the market sentiment is negative. Public participation phase. The trend becomes visible and more investors join in. Prices rise faster, volume increases. Excess or distribution phase. Everyone is optimistic now. The smart investors start selling to the latecomers at high prices. For a bear market, the same phases happen in reverse. 3. The averages must confirm each other. Doe created two main market averages: the industrial average and the transportation average, originally railroads. According to Doe, a major market signal is valid only if both averages confirm each other. For example, if the industrial average makes a new high, but the transportation average does not, the signal is weak. True confirmation happens when both move in the same direction. 4. Volume confirms the trend. Volume should increase in the direction of the trend. In a bull market, volume rises on upswings and falls during corrections. In a bear market, volume rises on downswings and declines during rallies. This shows the strength or weakness behind price movements. 5. A trend remains in effect until a clear reversal occurs. A trend continues in its direction until there are clear signs of a reversal. Temporary fluctuations or small corrections do not mean the trend has ended. Doe believed traders should stay with the trend until it proves it has changed. Hello everyone. Welcome to Lesson 3 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we'll learn how charts are constructed and why they are the foundation of all technical analysis. Bar chart 1. Purpose of charts. Charts are visual pictures of market movements. They show price action over time, helping traders identify patterns, trends, and signals. In simple words, charts convert market psychology into a picture so you can see what buyers and sellers are doing. Chart with upward trend 2. Types of price charts. There are mainly three popular types of charts used in technical analysis. A. Line chart. Simplest type of chart. It connects closing prices with a continuous line. Used to get a clear overall view of the market trend. Disadvantage: it hides details like highs, lows, and opening prices. Speaking head in silhouette example. If you just want to know whether the stock is going up or down over time, the line chart is enough. B. Bar chart. The most common chart in technical analysis. Each bar shows 4 key prices: opening price, high price, low price, closing price. This is often called the OHLC chart. Speaking head in silhouette tip. A long bar shows high volatility. A short bar means the price didn't move much that day. C. Candlestick chart. Originated in Japan. Each candle shows the same 4 prices, OHLC, but in a more visual and colorful form. The body shows the open and close. Wicks show highs and lows. If the closing price is higher than the open, it's a bullish candle, often white or green. If the close is lower, it's a bearish candle, often black or red. Speaking head in silhouette. Why traders love it. Candlestick charts are easy to read and show market emotion, fear, and greed more clearly. Tier of calendar 3. Time frames. Charts can be drawn for different time periods. Intraday, minutes or hours, for short-term traders; daily for swing traders; weekly or monthly for long-term investors. Speaking head in silhouette. Remember, the longer the time frame, the stronger the signal. Bar chart 4. Volume. Volume is the number of shares or contracts traded in a given period. It confirms the strength of a price movement. If the price rises with high volume, the move is strong. If the price rises with low volume, it might be weak or temporary. Round push pin 5. Importance of scaling. There are 2 main scales used on charts. Arithmetic scale, equal distance between prices. Best for small price moves. Logarithmic scale, each equal distance represents the same percentage change. Best for long-term and large price changes. Left-pointing magnifying glass 6. Summary of the lesson. Charts are the visual tools of technical analysis. Line, bar, and candlestick charts each have their uses. Volume and time frames add depth to your analysis. Understanding scaling helps you interpret price moves correctly. Direct hit conclusion. Charts are not just pictures, they are the language of the market. Learning to read them is like learning to read a story about fear, greed, and opportunity. In the next lessons, we'll learn how to identify trends, support, and resistance using these charts. Lesson 4. Understanding the trend. Hello everyone. Welcome to Lesson 4 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we'll learn about what a trend is, how it forms, and why it's the most important concept in technical analysis. Chart with upward trend 1. What is a trend? A trend simply means the direction in which prices are moving. If prices are moving continuously upward, downward, or sideways, it's said that a trend exists. John Morphy says, "White right pointing backhand index, the trend is your friend until it ends." That means, as long as the trend continues, Trade with it, not against it. Bar chart 2. Types of trends. There are three main types of trends in the market white down pointing backhand index. A. Uptrend. When prices make higher highs and higher lows continuously. It shows that buyers, bulls, are in control. Also known as a bull market. Speaking head in silhouette example. If a stock moves from 100 rupees, 120 rupees, 140 rupees, 160 rupees, it's an uptrend. B. Downtrend. When prices make lower highs and lower lows. It shows that sellers, bears, are dominating. Also known as a bear market. Speaking head in silhouette example. If a stock falls from 200 rupees, 180 rupees, 160 rupees, 140 rupees, it's a downtrend. Large white square C. Sideways trend or range-bound market. When prices move between a fixed range, neither up nor down. Buyers and sellers are equally strong. Also called consolidation or range trading. Speaking head in silhouette example. If a stock keeps moving between 100 rupees and 110 rupees, it's a sideways trend. Pair of calendar 3. Duration of trends. According to Morphy, trends can be classified by time duration white down pointing backhand index. One key cap primary trend lasts for more than a year. Shows the main market direction. 2 key cap secondary trend lasts for a few weeks or months. It's a correction or pullback within the main trend. 3 key cap minor trend lasts for a few days or weeks. Represents short-term fluctuations. Speaking head in silhouette. Remember, big trends are made up of smaller trends. Straight ruler 4. Drawing trend lines. The simplest way to identify a trend is by drawing trend lines. Uptrend line connects to or more higher lows. Acts as a support line. Downtrend line connects to or more lower highs. Acts as a resistance line. Speaking head in silhouette tip. The more times a price touches the trend line and reverses, the stronger that trend line becomes. Chart with downward trend 5. Trend reversal. When the trend changes. When prices break a trend line or fail to make a new high or low, it signals a possible trend reversal. Speaking head in silhouette example. If in an uptrend, prices stop making higher highs and start making lower highs, it could mean the uptrend is ending. Bar chart 6. Channels, price channels. If we draw a parallel line to the trend line on the opposite side of the price movement, we form a price channel. There are 3 types of channels. Ascending channel, rising upward descending channel, sloping downward horizontal channel, moving sideways. Channels help traders identify support and resistance zones within a trend. Direct hit 7. Lesson summary. A trend shows the direction of price movement. There are 3 types of trends: uptrend, downtrend, and sideways. Trends can last for different durations: primary, secondary, and minor. Trend lines and channels help identify and confirm trends. A trend reversal occurs when the price pattern breaks or changes direction. Conclusion. Identifying trends is one of the most important skills in trading. When you trade with the trend, your chances of success increase significantly. Always remember, white right pointing backhand index, don't fight the trend. Follow it. In the next lesson, we'll learn about support and resistance, the key tools to understand where prices stop and reverse.